Joined now for more on the markets by Shane Oliver. He's Head of Investment Strategy and Chief Economist at AMP Capital Investors in Sydney, and he's with us now. Shane Oliver, thanks very much indeed for joining us. First up, well, what are you making of all this data that we had out of the region? Is inflation still the demon that people were portraying it to be just day before yesterday?
It's still an issue. I think the good news is that the fall in the global oil price and some moderation, depending on which country you're looking at, some moderation in food prices is taking some of the pressure off the headline rate. Underlying rates are still under a bit of pressure, though, and that is, I think, because interest rates in the region are still very low in real terms, and yet capacity utilisation has been, or there's not a lot of spare capacity left around after the rebound of the last couple of years. So I think inflation's still an issue. It's not just as big a concern that might have been the case over the last 6 months.
That's right. Inflation seems to have been put on the back burner as we have these issues unfolding in the Eurozone. But it seems that risk is back on in the markets. Are you as optimistic as what we're seeing?
Well, I'm optimistic on a 6-month and 12-month horizon. I'm a bit unsure about the very short term. I think what's really happened here is that markets fell so hard into their lows a week or so ago. Then they got very oversold. The worst was feared regarding Greece. A global downturn, not necessarily a recession, but a sharp global downturn was factored in. Then we started to get better news out of Greece, and consequently markets have rallied partly in anticipation of that occurring. It's almost as if Europe was looking over the precipice and has suddenly pulled back from that, so the European situation is looking healthier. There's also some positive signs, I think, when you look at the US. If you look at 3 of the regional business surveys released this week, that's the manufacturing PMIs, 2 of those 3, including the Chicago survey last night, showed an improvement, suggesting that the worst of the slowdown in the US is probably behind us. And even though the ISM index, which comes out tonight US time, will probably be fairly soft, the likelihood is we should start to see a rebound through the second half of the year. I think the other piece of good news has been out of Japan, which was hard hit by the earthquake, but there's signs there that the Japanese recovery is now coming through, which should in turn help global supply chains. So I think we have started to see at least less bad news, but in many cases actually good news coming through, and that's helping the markets.
I've heard numerous guests, I don't know if you've heard the same thing, Rish, but they're saying this is like a replay, Shane, of 2010, when basically markets stutter through some of the summer, but then close to the end, into the fall and the rest of this year, we're going to see gains.
It does feel very much like 2010. Markets rallied into April or thereabouts, making nice highs. And then suddenly we start hearing about Greek debt problems. Markets started coming down. Risk was turned off. And then, of course, Greek got its bailout in May last year. And then, of course, we saw more weakness out of US economic data going into June. So around mid-year, June, July was basically the bottom. And also at that time we had concerns about a hard landing in China. And then, of course, when we got to the middle of the year, suddenly the data started to look a bit better as we went through the second half. Then we got the run-up to QE2. And, of course, share markets had a good second half through late last year. And I'm starting to wonder whether we're going to see the same thing this time around again. Markets did sell off very hard into the middle of the year. We're now starting to see some base building, if not a turnaround in markets, which I think augurs fairly well. Big unknown, though, of course, is whether we're going to see QE3 this time around. At this stage, I'd have to say the hurdle for that is pretty high, given that deflation is not as big a threat in the US, and the Fed, I think, rightly regards the slowdown seen in the US as temporary.
Yeah, sell in May is what you said, well, is what you're saying there, like last year, sell in May, go away. But what about that prospect that you have printing more money here? We had the Fed just yesterday, I think it sold off its last $4 billion out of the $600 billion program that it did have in place. Many commentators are actually suggesting we're going to have more volatility because we don't have that certainty of the Fed being in the marketplace.
That's certainly possible. In fact, I think volatility will remain the name of the game. Right now we're seeing relief rallies around the world, but the reality is that the global economic recovery will remain a fragile one, even though Greece looks to have dodged a bullet for now. No doubt 6 weeks, 6 months or whatever down the track, they'll be running into more trouble again as the latest austerity measures put more pressure on their economy. And likewise, other European indebted countries face issues as well. And then, of course, in the US, there's problems with fiscal policy, the debate about the debt ceiling, the likelihood of more spending cutbacks to get that debt ceiling raised. So the global recovery, I think, will remain a fragile and messy one, at least in the advanced countries. I think the key, though, is that it probably will continue. Monetary policy will remain easy, even if we don't see another QE3. I think interest rates will stay very easy and the Fed's balance sheet will stay very high, which in turn I think will underpin gains in markets. It's just that the ride will remain somewhat volatile. The other piece of good news to note, I think, is the emerging world, where China's a classic, where growth has cooled, but I think it's now cooling to a point where it takes pressure off inflation, but it hasn't collapsed. There's no sign of any hard landing coming through in China. So the emerging world overall, I think, is a good source of strength for the global economy, even though we're going to see this ongoing volatility and constraint in the advanced world.
Let's talk about China first of all before we move to other countries in this part of the world. And we have this PMI reading today, the Purchasing Managers Index for manufacturing, falling back to the slowest level of growth that we've seen in 28 months. Should we be worried?
There's no doubt that when that indicator is falling, it is a concern. And of course, when it fell in late 2008, going into the global financial crisis, then that was a concern, and Chinese growth did slow down. Of course, it fell a lot lower than is currently the case. My feeling is that whether you're going to a slowdown or a hard landing, they always feel the same at the start. And of course, right now, the message is that the Chinese economy is slowing down. If you track the current level of that index across the history of growth in China, it's still consistent with about 9% growth, which would roughly be our forecast for this year. I think the key thing is that the Chinese authorities will be looking at that, and that the focus on the part of the Chinese authorities will now shift from being worried about inflation to focusing on growth again. So even though we'll probably see a further rise in inflation when the figures come out in a couple of weeks' time for the month of June, maybe up to around 6% inflation, I think the authorities will probably look through that. And even though we may see one more rate hike, maybe not, I think that the key message from all of this is the tightening process in China has now come to an end, and that there's no way the Chinese authorities are going to let growth have a hard landing there.
Yeah, absolutely, Shane. That's what I wanted just to ask you, because it does seem that many commentators are no longer really thinking that another rate hike is nailed on.
Yeah, it's not as certain as it was. I think there's enough indicators coming out of China to suggest that growth has slowed. It's coming back under control. If history is any guide, the slowdown in growth and the slowdown in money supply should lead to lower inflation through the second half of the year. Therefore, right now, the authorities can sit back, leave rates where they are, probably, and then as we go through the second half of the year, if anything, start to get the foot off the brake a little bit. So I think the Chinese tightening story has largely come to an end, and they'd probably, if anything, be welcoming the signs of a cooling in their economy.
Shane, thanks a lot for that. Shane Oliver there from AMP Capital.
My pleasure.